You've probably heard people talking about staking and yield farming in crypto and wondered which one actually helps you earn more. Or maybe you've tried both and still feel a little lost. Don't worry, that's exactly what we're breaking down today. By the end of this video, you'll know exactly how staking and yield farming work, the risks and rewards of each, and practical tips on which might be better for you in 2026. Let's jump in. First up, staking. Think of staking like putting your crypto to work while you sleep. You lock up your coins in a blockchain network to help it run smoothly, and in return, you earn rewards, like earning interest at a bank. Here's how it works. Blockchains like Ethereum, Cardano, or Solana rely on validators to confirm transactions. You don't have to be a validator yourself. You can delegate your coins to one. They do the work, and you share in the rewards. Rewards are usually paid in the same crypto you stake, and they can range from 4% to over 20% APY, depending on the network. But remember, your coins are locked for a set period. If the price drops during that time, your potential gains could shrink. And if the network slashes a validator for misbehavior, you might lose a portion of your stake, though this is rare with reputable networks. Now, let's talk about yield farming. This is more like active farming. You're putting your crypto into decentralized finance platforms to earn more crypto. But instead of just staking, you're providing liquidity to trading pools. Here's an example. You deposit a pair of tokens, say USDC and ETH, into a liquidity pool. Traders use this pool to swap tokens, and you earn a portion of the trading fees. Some platforms even give extra rewards in the platform's native token. The upside? Rewards can be much higher than staking, sometimes 50% APY or more. The downside? Prices of the tokens can fluctuate, which leads to something called impermanent loss. Basically, the value of your deposited crypto might change relative to each other, which can reduce your net profit. And don't forget platform risk. Hacks, bugs, or sudden protocol changes can happen, so picking reliable, audited platforms is crucial. So, which one's better? Well, it really depends on what you want and how comfortable you are with risk. If we talk about staking, then it's basically low risk. You get pretty predictable rewards, and it's mostly hands-off. It's perfect if you just want a steady, safe way to grow your crypto without constantly checking charts. Now, yield farming is a bit of a different story. It's higher risk, but the potential rewards can be way bigger. You'll need to be a bit more hands-on, keeping an eye on your positions and understanding how these DeFi platforms work. It's better suited for people who are okay with market swings and want to chase bigger gains. Before you jump in, here are some practical tips. Start with staking to grow your holdings steadily. Once you're familiar with blockchain networks, try small amounts in yield farming to explore higher gains. Consider diversifying. You could stake your main holdings for security and use a smaller portion for yield farming. That way, you're balancing risk and reward. Research platforms carefully. Check audits, reviews, and the team behind the project. Not every DeFi platform is safe. Understand lockup periods. Staking might lock your coins for days, weeks, or even months. Know this before committing. Start small. Don't put all your crypto into one pool or network. Experiment with a small amount first. Track rewards and fees. Yield farming can have transaction fees, especially on Ethereum, which can eat into profits. Layer 2 solutions or alternative chains can reduce this. Use calculators. Many platforms provide staking and yield farming calculators to estimate rewards. Don't rely on promises alone. Remember, crypto is volatile. Only use funds you can afford to lose. Even staking carries network and market risk. It's not a guaranteed income. In 2026, staking is becoming more beginner-friendly than ever. Mobile apps and web platforms now let you stake your crypto in just a few taps, without needing to understand all the technical stuff behind the blockchain. Features like auto-delegation mean your coins are automatically assigned to reliable validators, so you can start earning rewards without constantly managing your stake. Yield farming is evolving too. DeFi protocols are rolling out features designed to reduce risk for users. For example, some platforms now offer impermanent loss protection, so your returns are less affected by token price fluctuations. Others provide more transparent reward structures, showing exactly how much you'll earn and what fees you'll pay upfront. In short, 2026 is shaping up to be an exciting year for both staking and yield farming. Staking is becoming simpler, safer, and more rewarding, while yield farming is finding ways to balance higher returns with lower risk, opening the door for more beginners to explore it confidently. If you found this helpful, hit like, subscribe, and comment below. Have you tried staking or yield farming yet? Share your experience. We'd love to hear it. Until next time, keep your crypto smart and your gains steady.